Imagine waking up tomorrow and realizing your money is worthless, your bank no longer exists, your job is gone, and the government has no solution. That didn't happen in a poor country. It happened in the richest economy on Earth. This is the story of how confidence collapsed and took the world economy down with it. The Great Depression was the worst economic collapse in modern history. An economic depression means a long period of severe economic decline marked by mass unemployment, falling incomes, collapsing production, and widespread poverty. Between 1929 and the late 1930s, 1 in 4 Americans had no job, industrial production fell by nearly 50%, the stock market lost almost 90% of its value, the crisis spread across the entire world. This was not just a recession, this was a system failure. So, what caused this Great Depression? Before the collapse, the 1920s looked perfect. Factories were booming. Cars, radios, and electricity transformed daily life. The stock market kept rising. This decade was called the Roaring Twenties. But beneath the surface, there was a problem. Here's the key issue. Productivity increased rapidly. Wages did not increase at the same speed. Wealth concentrated at the top. This meant that the economy produced more goods than ordinary people could afford to buy. Growth existed, but it was unequal and fragile. In the 1920s, stock prices rose rapidly, not because companies were improving, but because people expected prices to keep rising. This behavior is called speculation, buying assets not for long-term value, but to sell quickly at a higher price. This created a bubble. When asset prices rise far above their real economic value, a bubble forms. People stopped asking, "Is this company profitable?" They only asked, "Can I sell this for more tomorrow?" Buying on margin. This is one of the most important causes. Buying on margin means when people purchase stocks using borrowed money and pay only a small portion up front. Example: if a stock costs $100, the investor pays $10 and pays the $90 with borrowed money. As long as prices rise, profits are huge. But when prices fall, brokers demand repayment immediately. This demand is called a margin call. Investors are forced to sell instantly. Millions of people did this at the same time. Fear turned into panic. In October 1929, panic selling began. Prices collapsed. Confidence vanished. This event is known as the Wall Street crash of 1929. A point to note, the crash did not cause the Great Depression. It triggered deeper failures already in the system. At the time, the banks worked differently. There was no deposit insurance. Banks invested customer money in stocks. Regulations were weak. After the crash, the people rushed to withdraw savings. This mass withdrawal is called a bank run. Bank run is when many depositors try to withdraw money at the same time out of fear. Banks didn't have enough cash. Between 1930 and 1933, over 9,000 banks failed. Millions lost their life savings. The institution responsible for stabilizing the system was the Federal Reserve, but it failed to act decisively. The economy faced overproduction and underconsumption. Producing more goods than consumers can afford to buy is called overproduction. Underconsumption means consumers lack enough income to purchase what is produced. Factories produced goods. People couldn't afford them. And as a result, it led to unsold inventory, factory shutdowns, mass layoffs. This reduced incomes even further, creating a vicious cycle. Then came deflation. A general fall in prices across the economy is called deflation. This sounds good, but it's dangerous. Why? People delay spending, business revenues fall, wages are cut, debt becomes harder to repay. Deflation freezes economic activity. The Federal Reserve failed here. Instead of increasing money supply, interest rates stayed high. Credit was restricted. Money supply shrank by 30%. Money supply means the total amount of money circulating in the economy. This deepened the collapse. Modern central banks act differently today because of this mistake. The U.S. government passed the Smoot-Hawley Tariff Act. What is a tariff? It is a tax placed on imported goods. Its purpose was to protect domestic jobs. But instead, what actually happened was, other countries retaliated. Global trade collapsed by 65%. The Depression spread worldwide. Protectionism made everything worse. The human cost of this event is not talked often. Breadlines, homeless families, farm foreclosures, children leaving school, Dust Bowl droughts destroying agriculture. This economic pain reshaped politics and society worldwide. Governments abandoned the idea that markets fix themselves. The changes made were government job programs, banking regulation, social security systems, and the World War II spending finally restored full employment. But reforms ensured no repeat of such collapse. The Great Depression proved one brutal truth: when trust collapses, money follows, and when money disappears, society breaks.